Good morning, good afternoon, good day, wherever you are in the world. Thank you for joining. This is Jason with Top Shelf, and it's great to have you all here with us. It is right at the strike of noon Eastern, and for those of you on the East Coast here in the U.S., grabbing a sandwich or getting lunch, thank you for joining us. Those of you throughout the other time zones, it's a pleasure to have you here with us. We have folks filtering into the room still, so let's just go ahead and do a quick sound and visual check. We are thrilled to have Jeremy Newsom here. He's sharing his screen. Give me a quick yes and yes in the questions box, letting me know that you can see his screen and that you can hear me okay. All right, Neil, thank you. Right on, John. Ahmed, Robert, fantastic. Okay, great. Well, we're going to roll right along. It's in the interest of time and the fact that it's a Tuesday. Let's keep cooking here. Jeremy has been a long-term partner with Top Shelf over the last several months. We publish his content, we share his videos. He is just an all-around great guy. He's one of our favorites to work with. And today he's going to be talking about something that's a little bit different, using historical replay to optimize your trading performance. So over the course of the next 45 or so minutes, we're going to look at a handful of things. You can go back and back test some strategies using this, how you can practice and hone your trading skills. You'll hear us talk a lot about practice. And then also, he's going to talk about a tool that some of the best traders in the world use. Now, if you've heard of Jeremy before, that's not by accident. He is a well-known name. He's been trading since he's 21. He specializes in candlesticks, gaps, credit spreads, day and swing trading. But he's also the founder of reallifetrading.com, which incidentally has some absolute kick-ass t-shirts. But that's has some great content for traders at all levels. So, Jeremy, with that as the intro, I am going to bow out, my friend, and I'll be here on standby looking at questions. But
beautiful.
I'll turn it over to you. Thanks for joining.
Thank you. Yes, thank you so much, man, for that intro, and just thanks for being a kind person and being very professional and getting all this set up. It means a lot to me. And for those who are here live, thank you for taking your lunchtime. Like I said, if you're snacking on a burger and you're investing in yourself, you're learning a little bit while you're here, that is absolutely terrific. Just want to say thank you. We are going to rock this out. I'm really jazzed up. First and foremost, what we're going to do is we're looking at a charting software, and I don't have any PowerPoint presentation for this episode that we're working on together. This is all going to be from memory, and this is all going to be based on the charts, because as traders, that's how we make our money, not from PowerPoint presentations, but we actually look at the charts kind of in real time and want to chat about what things look like, why they look like that, entries, exits, stops. We're going to be trying to do our best to answer all those questions. So this particular charting software, I don't get paid to endorse it. It's just called tradingview.com. The reason I use it is because it is free for most traders. So you can access this on your phone. You can access it at work. It's a browser-based. Tradingview.com, just simply saying, it's a cool software. I like it. And what we're going to be doing today is using, as Jason mentioned, the historical replay or the replay mode that you can see right here. And in using the replay mode, I'm going to go back in time and actually look at a stock that you all suggest for me and a time that you all suggest for me, and then kind of rock it out from there. But I did want to make sure that I can still see your questions. So if you want to throw in a 2 to see if the chat pane works on my end, I did mention to Jason that I think I might only have presenter access. So he might have to help me with some of the questions as well. Just because as of right now, I'm only able to see the staff names and no questions.
Hey, Jeremy, let me change you to be an organizer, and hopefully this doesn't trip anything up here.
No worries, let's do that.
Okay, there you go. Because Sylvan, Robert, Ahmed, they all came in.
Yep.
So there you go.
That is exactly what I need. Wonderful.
Right on, okay.
Thank you, sir. Thank you. All right, Ahmed, beautiful. Sylvan, how are you? John Clay's in the building. Neil, I love it. Wonderful, fantastic. All right, so I want to make sure I used the chat pane because I did want to specifically look at some stocks and back trade some stocks that you all requested. And it's almost like a magic trick because I'm going to pull up whatever company you want and I'm going to go back test whatever year, and I'm going to show you how I personally use this tool to sharpen the sword, so to speak. As traders, we want to always get better, right? Practice makes permanent. Each one of you have all heard about the 10,000 hours, right, to mastery, 10,000 hours of mastery. And that is something that if you want to master this, the stock market, if you want to master the markets, or if you at least want to get that 10,000 hours under your belt as fast as possible, this functionality and this tool that we'll be using today is an exceptional way to do that. All right, so what we're going to do is, just to make sure everyone's all lively and I pick people at random, I want someone to answer this question for me. 2 + 2 = what? And the answer, that I will, first person types it in, perfect. Sylvan was the first person to type in 4 into the chat pane. So Sylvan's going to choose what stock we look at together today. So whatever stock you want, type it into the chat pane, and that's what we're going to go back trade, and then we're going to pick other people, and they're going to pick the time frame for me. So Sylvan typed in VALE, beautiful. All right, so we're going to look at VALE, but before I do that, I want someone to pick the year for me. What year are we going to start in? And the person who's going to do that is going to be the person who answers this question. 5 + 5 = what? Figure we'd just start off with a little bit of brains, a little bit of math. So Robert Williams was the first one to type it into the chat pane. So Mr. Williams, what he chose 2016. All right, 2016. And then John, since you're really active in the chat pane, Mr. Clay, what month should we start off with in 2016? So whatever month you pick. So what I'm gonna do is I'm gonna pull up the chart. I'm gonna pull up VALE, I'm gonna go to the month, and then we're just gonna start September. Okay, so here we go. Gonna hop over, and I think I can just delete these. Yep, all right. So VALE, that's a V, not a B. And this is not Vail, Colorado. Even though that is publicly traded, this is not what that is. So I'm gonna go back to 2016. We're gonna go back to September. And there's September 1st, and we're just going to get this replay mode started. Here we go. All right, beautiful. So just so that I can kind of walk you through it, what I did, very easy, is I simply went to this button. Let me move this out the way, sorry. Went to this button where it says replay, and I went to the stock chart, VALE, that was requested in the chat pane by Sylvan. And once you type it in, you can just click on whatever day and whatever time frame. By the way, this also works on. So if you are a day trader, you can practice this on a 5-minute chart. If you're a swing trader, you can practice this on the hourly or the daily. Totally up to you. You can do weekly. So anyway, you can choose your time frame. You can go back in time. And this approach is what is massively helpful to practice trading, to get a really good idea and to learn whatever strategy it is that you want to talk about. So this particular session, we're going to be focusing on candlesticks, the sentiment, and you are all really fired up. Thank you again so much for your participation. This is going to be a wonderful, wonderful session. What I'm going to do first and foremost is I'm going to look at just candlesticks, nothing else, candlesticks, support, resistance, and then I'm going to draw some lines. So I'm going to draw some lines on the daily chart. So I'm going to zoom out a little bit so you'll notice, right, I can't see anything to the right. I'm going to zoom out and I'm going to do some support resistance lines. So that's the first thing I'm doing. And then I will show you why I'm choosing those lines and what prices I looked at. So those 3 lines I think are enough for right now. You don't really need that many. This line up here I drew based on this support resistance back from 2006 to 2009. This line was based on that little pivot right there, and this line was based on that pivot right there. Those are the 3 things that my eyes saw to help me draw those lines. Now, once I draw the lines, and this is the same process anytime I'm looking at a brand new company, is once I get my lines in, then I ask the question, okay, What is the trend? What is the trend? Because once you answer this question, you will also be really able to determine and figure out time frame. Right? How long are you going to be in things? How are you going to be taking the trade? Is it bullish? Is it bearish? Are you quick? Are you in? Are you out? So this trend, I would say, is right now pretty bearish, relatively speaking, and then you have a little bit of sideways in here, but mostly on the bear side. So if I go bullish, I'm going to be getting in and getting out very quickly, and I'll probably be looking for bearish setups as well, because that is right now I would say is the trend. Now on a shorter term level, I think people could easily make the argument, yeah, it's bearish, but it's also a little sideways recently. We've been trading kind of sideways for about the last year. So there's a little bit of neutrality in there, and I think that is something that we could easily talk about as well. So now what I do is once I determine the trend, so we're a little sideways, kind of bearish, kind of bullish. It's a little, not really bullish at all. It's more neutral, more bearish to neutral. So that to me says I'm going to try to buy as low as I can. I'm going to be getting in and out pretty quickly and going to be trying to play some fast, aggressive moves if I'm getting to the trade bullish. So now I'm just going to zoom into a daily chart. And again, this practice for me is going to be all about candlestick recognition and asking questions about sentiment. What are people thinking? What are they doing? And now you'll notice I only have about 9 months on my screen, so 2016 to September. So the next thing I do, once I draw my big lines, I'm going to draw some primary lines, just whatever lines your eyes see. 2 or 3 lines is plenty. You don't need that many. 2 or 3 lines. I'm going to draw this one, and I'm going to draw this one. And that's the 2 lines I think I'm going to add on the daily chart. So now what I'm going to try to figure out is, what is this stock doing? What is the company doing? What is the sentiment of this trade? That is the next question that I'm asking, and that's the next thing that I'm always looking for. Sentiment. What are the traders feeling? And that's what candlesticks are going to help you with, and they're going to help determine for you when you're looking at a particular trade, what is the candle saying? What is the chart saying? What are the traders feeling? That is the sentiment. That's what it is feeling. Because you know you're trading buyers and sellers. You're actually looking at, this is a visual representation of real people taking real trades. So what are they feeling? That's the question that we need to ask, and then we need to answer with our trading, because if we can do that, then we'll have a really good understanding of what something might do. So since we know that we have a little bit more of a bearish play out there, what I'm gonna do is I'm gonna zoom in here a little bit more, and we can make the argument that this blue line is a resistance that I drew. So it's old support, new resistance line. This pink line that I got in here is a little bit of a trend, so that's kind of like the current trajectory. So what's interesting about this particular price is we have to use what is in front of us to kind of make a determination of what VALE might do. First and foremost, what we could say is this is a support resistance. So if we're going to go bullish, I'm probably going to need a break above there, a retest, and then a bounce higher. And since we're obviously short term making higher highs and higher lows, if I'm going to go bearish, I probably need a close below that support. So this is where things get fun, right? We've done the analysis. We have a general idea of, okay, it's out of support. There's a little bit of a resistance above our head. If we're going to go bearish, I'm going to need a close below here. So let's go end of day close below 517. And this is what I call Mr. Squiggles. I'm going to draw on my screen what I want the stock to do. So if it starts doing it, then I know that I'm prepared and ready to take the trade. So on VLE, that's what I'm looking for. I'm looking for it to break above the support resistance line that I have, and then I'm going to look for a bounce. Why am I wanting that pattern? Let's ask this question. Is there a time where it has done that before recently? What do you think? Are you able to see it? So what I'll do is I'll take the exact line that I just drew, and I'm going to move it back a little bit. Check that out. How epic is that? So that's the exact same pattern that it did about a month ago. Same exact thing. That's what I refer to as the S curve, the pullback, the retracements, the retest, whatever you want to call it. So the same exact pattern that happened, right? A bunch of white candles came in, we broke above the resistance, we retested and bounced. That's what I'm looking for to occur. So if it starts occurring, then we'll set up a trade and we'll kind of go from there. So, okay, now what we do is we just press the next button. We go forward one candle. Ah, look at that. Now this is where it gets exciting. So ladies and gentlemen, yes or no? So far, is it doing what we wanted it to do for the bullish trade? I would say, yeah. So far, it's doing it, right? It bounced off support. And now what we want to do is we want to ask the sentiment of this chart. We want to look at and determine what people are thinking. And that is able to happen with candlesticks. So if we're looking at this candle, this is a bullish candle. We know for a 100% certainty that people are buying there because it's a bullish candle, it's a white candle. If you use red and green, that's totally fine. I just use black and white. White candles are bullish. As long as you know what candles are bullish and what candles are bearish, whatever color you use is totally fine. So on VLE, let's extrapolate the sentiment from these candles that we see. We have this bullish candle and then we have this bullish candle. This particular gap is something that I refer to as a retest gap. Now, the cool news is this piece of information you can use for the rest of your trading career. This is a really good takeaway. White candle gapping up, aka a bullish candle gapping up, is what I refer to as a retest gap. Now, why do I call it a retest gap? Because the buyers who bought on the first day, they are now profitable on the second day. So most likely they're going to start selling at some point, and that gap will oftentimes fill. So very similar to this gap right here, white candle gapping up. What you'll notice is the trade went up, it pulled into the gap, and then it bounced. Exact same pattern that I have drawn on the screen. In fact, this pattern will show up in so much of your trading. It's outrageous. So white candle gapping up is a retest gap because we know for a 100% certainty that someone somewhere in the world bought on this day. It's just that simple. It's an absolute fact that someone bought on the 1st of September. So if they bought and they're now profitable, what do most people do when they're profitable? They sell. So what I'm going to do now is we've created the plan. We've said, okay, this is what we're going to do, and now we're going to simply do it. So we're going to put an entry here as a limit buy, and we're going to put our stop pretty much where we were going to go bearish at one point, and that's going to be our setup. Now, another thing that I want you to all to take away from today's session is how I personally determine, calculate, and mitigate risk. Ironically enough, most presentations and presenters that I've attended, they always talk about risk mitigation, but they never show you how they're going to do it. Have you all ever noticed that? So let me share with you right now the simple formula for how I do it. It's really easy, actually. And this is the only time that you're ever going to hear this. Again, most people never, ever, ever talk about this. It's kind of crazy. So we all know to risk 1% of the account. We get that. So let's say you have a $30,000 account. Okay, 1% is 300. That's cool and all. That's not special. Everyone knows that. How do you then calculate your position size based on that number? Well, the answer is you take your risk, which is $300, and you divide it by the difference of your entry and stop, and that will give you the amount of shares. So we did some math earlier. Who wants to do that math for me? All right, so we have 300 divided by, so you have 544. We'll put this in parentheses. 544 minus 516. And some of you might have to go back to second grade. Please excuse my dear Aunt Sally. Right, so we're going to do the parentheses first. So 544 minus 516. What's the math on that, my friends? Simple calculation, pretty easy. Bust out your calculator, or you can. Some of you might be able to do that in your head. What do you guys think? I want to make sure you all get the answers correct. So I'm just going to wait on you. So the answer to that is 28 cents. and Sylvan already did the whole thing for us. So our stop is 28 cents. And now you take 300 and you divide it by 28, or divide out of, and you're going to come up with how many shares that you could buy in this situation. 1,071.4, but that's how many shares you're going to buy. So you're going to buy 1,071 shares. Now, why is that important to know? The reason it's important to know is because what this does is it gives you a lot of certainty. It lets you know with a pretty high degree of certainty, unless you get a weird gap or something that goes against you, you'll know how many shares to buy. And number two, you'll also know how much money you're going to lose on a trade. Type in a 3 if you've ever lost a lot more money than you wanted to on a particular trade because your position size was too big. I'm gonna type in a 3 because that's definitely happened to me. Hopefully I'm not the only person that's happened to. I'm gonna throw in a 3 because that has absolutely occurred. This will help you insanely reduce that. So this math formula on the screen is the math formula that I personally use, and very rarely will anyone else ever share this formula with you. I don't know why. It's not like it's a hidden formula. I personally think that most people just don't know it exists, or they don't know how to calculate risk, whatever the case is. But this will help you mathematically determine your risk. It's 300. The reason it's important, I'm gonna spend 2 minutes on this. The reason it's important is because if you have one trader and they risk 300 on every trade, right? 300, 300, 300, and 300. That's their risk. And on this particular trade, they win 300. On this trade, they win 600. And on this trade, they lose 300. And on this trade, they lose 300. Okay, and then you have the exact same trader, taking the exact same trades. There's a $300 risk, $300 risk, $300 risk, and then they do a $3,000 risk. All right, and I'm gonna do the same exact math. Okay, so they win 300, they win 600, they lose 300, and then what happens, ladies and gentlemen? They lose 3,000. And here's the crazy thing. The only difference between these two traders, let's say they took the exact same trade to the exact same penny, to the exact same thing. The only thing they did different was change their risk on the fourth trade. That's all they did. I hope this sinks in, because that's how important risk mitigation is on trading. Most traders really fumble this part of their trading. They end up risking too much on a trade, and then they lose on it, and now they're in the hole. Whereas this trader is up and this trader is down, all because the second trader changed their risk. How wild is that? And most traders do have a different risk. They'll take a trade on it, they'll take a setup, and they'll go, yeah, I feel okay about this one, so let me put in 1,000 shares. And they go, oh, I feel really confident on this one, let me put in 2,000 shares. And the challenge with that is, if you always change your risk, you're going to have variables. And if you change your variables, you're not going to know what your skills are, because you're mostly going to be losing money because you're going to be risking too much or too little. So anyway, I hope that was beneficial. So now we know how many shares to buy. We can buy 1,071 shares. And so again, we have our risk, and this is how we can just type it into the broker. All right, 1,071 shares. So this is one risk unit. And now we will find out if the analysis is going to work. Because from here, ladies and gentlemen, the most important aspect of the trading is now quite simple. We've done the analysis. It's bouncing off of a support. We know it's a retest gap, and most likely it's going to trade back into that gap and potentially bounce. Will it bounce for sure? We have no idea. But if you are comfortable with your risk, most traders, if they're comfortable with their risk, they are more likely to take the trade. A lot of traders wait for the perfect trade. They wait for something that doesn't exist called confirmation. They wait for confirmation, then they take the trade, and by that time it's too late, and then they end up losing money. Because once a trade looks insanely obvious, it usually isn't. The market is designed to fool most people most of the time. The best trades, my friends, the best trades are often the most uncomfortable. Have to remember that. The best trades are mostly the most uncomfortable ones, right? You're buying when no one else is buying. You're buying low. You're buying a retest. You're buying a pullback. Nothing oftentimes will tell you if the trade's going to work until it starts working. But you have to be in. So this is what we're going to do on Vail. We're going to set it up. And this process, this procedure, this practice will help you trade in the future because you're going to get really comfortable and confident at the trade, right? You've built a foundation of, yep, I know this is how it works. I'm comfortable with it. I know the procedure and the process. I get it. And then you can apply that to a real-time market. So it's just all about building that foundation. Now, this is super exciting, kind of, sort of. So what I'm going to do is ask a question. So on this candle right here, let me delete that drawing. Ladies and gentlemen, yes or no? Did the trade retest? What do you think? Yes or no? Did the trade retest? Down, 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 down. It's like my Jeopardy song. My boy Ken Freeman's in the building. Ken, so Ken has his answer. Anyone else want to throw an answer in there? Did the trade retest? The answer after we come back with this series of commercials. Ashok says not yet, and then Ahmed, Robert, and Ken say yes. The answer is yes, it did. It did retest because we can literally see that structure. We can see that it closed here, came all the way back and bounced. So it did retest, it did pull back. Now here's the thing, I'm going to take worst case scenario in this situation. The low of this candle, do you guys want to know what the low is? The low of the candle was 544. 544. So I'm going to go with worst case scenario. I'm going to say that probably didn't fill. It might have, right? On a cheap stock like this that has really good volume, it really could have filled. It just depends on the bid ask. Maybe it depends on the broker. I'm going to say it didn't fill. It probably didn't. But it did retest. We know that for sure. Now, the cool point is, the big takeaway, ladies and gentlemen, is it did retest the exact price I thought it would to the penny. I hope that's kind of a cool takeaway. We're like, wow. Because if I can save you a penny 1,000,000 times, right, it's a lot of money. And also, it's the difference between getting in here and then getting in up here. That's 30 entire cents. 30 cents. So I'm going to say that we did not get filled, and then go with some further analysis and just go, all right, well, good try, didn't get filled. We got their wave rotation that I wanted. So now the question is, could I buy another pullback? Well, absolutely. If I did another pullback, it'd probably be about halfway into this candle, and I'd probably put the stop right about here, move the stop up some. And again, what I'm trying to accomplish on this one is to see if it does something like this, right? A pullback, buy the dip. And now you're going to have to change your math formula because you've adjusted your numbers. 557 by 532. Okay, so when you do that math, that's going to give you 537 minus, 557 minus 532 is 25 cents. So now we're dealing with 25-cent risk. And so if we have a 25-cent risk, that means that we are going to be doing 1,200 shares. Interesting. So I hope that's a big takeaway for some traders. We just increased the amount of shares, but our risk is the exact same. It's still 300. All right, so let's go forward one more candle. Bam. We are filled. Now, what's cool about this is we did retest, and in fact, if you did a limit buy at 557, right? Because you'll notice that's a limit buy. It opened at 554, so we would have gotten actually filled at 554 on this trade. Our fill. So that's our fill, was 554, because that's where it opens. Open was 554, the low was 553, so we would have gotten filled at 554. So we got filled on a pullback. Now, let's ask the question, why? Why did I do a limit order? How did I know that most likely that stock would pull back? Ready for another takeaway from today's free webinar? Here you go. If you have a big candle, the stock, I'll just say, the price action will usually retrace, retest, pull back. Now, when I say big candle, I think we can all agree that that candle was a big candle, right? This one was pretty average right here on September 1st, but this one on September 6th, I would say that's a pretty decent sized candle. This is a big candle right here, and you can see this is a big candle, this is a big candle, and both of those candles, you got that retracement. You eventually got the pullback into that candle. That happens pretty frequently when you get these big candles like that, what I refer to as long day candles. So if anyone has any questions, go ahead and type them into the chat pane. We got about 20 more minutes, and we're going to see if this trade works. We're going to find out what it does, because we have our stop in place, and our risk was only a quarter. So if it starts bouncing and making new highs, I'm going to go ahead and take some of our risk off the table, lock in some gains, and see where we go from there. So next candle, a little bit of a bearish candle. It did make a higher high and a higher low. So as of the close of this day, we're down on the trade a little bit. So let's see what the next candle brings us. Next candle, we get stopped out. Bam. And what's real cool about this is how much money on this trade did we lose? $300. Exactly. That is correct. Mathematically, you're welcome to do the math. If we got in, we actually got a little bit, it would have been a little bit less than 300 because we had a fill at 554. Would have been a little bit lower. And now what we do is we have a brand new set of candles. We have a brand new set of analysis. We're going to go, all right, that didn't work. We got stopped out. We lost 300 bucks approximately. So now what do we do? So we tried to take the trade bullish, did not work. All right, well, our initial analysis early on was that if we get a close below this level, we're going to go bearish. And we're going to talk about that in just a moment. I think I can delete this now, because now we have another type of gap. What you'll notice is this is a black candle gapping down. Black candle gapping down. So if a white candle gapping down is a retest gap, is a black candle gapping, white candle gapping up is a retest gap. Black candle gapping down is also a retest gap. This is also a retest gap because how are bearish candles formed? Bearish candles are formed by short sellers. So we know with a 100% certainty on this candle right here, we are very confident that someone somewhere in the world sold short that day. Someone somewhere in the world sold short. Had to happen. So this candle, they're profitable. How do short traders exit their position, ladies and gentlemen? How do short traders exit their position? Exactly, they buy to cover. Buy to cover. So this buying oftentimes will create a retest and then a potential rollover. So what I'm going to do is I'm going to come up with a plan for what I want this particular stock to do, and I'm going to write it down on the chart, and then I'm going to follow that particular plan. So here's the plan. I want a white candle to come in tomorrow, and if that occurs, I'll take a bearish breakdown. Now, what if a white candle doesn't come in? That's okay. We'll come up with what we're going to do then. But if we get a bullish candle tomorrow, I'll be more inclined to take a bearish breakdown. Here we go. Next candle. Nice. Woo-wee. Beautiful stuff. So what did this allow us to do? Even though we got stopped out, we said, okay, got stopped out, but we recognized the sentiment of this gap. And the sentiment of the gap is a retest gap, black candle gapping down. Ladies and gentlemen, is this the retest, yes or no? The answer is yes. Yes, it is. So bam, gap down the next day. A bunch of traders started buying to cover because that's how they locked their position in. And now we've rotated higher. So in order for me to go bearish on this trade, I have the white candle and I said, okay, if we take out this low, this is going to be my bearish trigger. So let me come in here, bearish trigger. And I don't have a bullish set up yet. I'm probably going to wait on the bull because we just tried a bull and that trade did not work. And remember, the overall trend is bearish. So any kind of bullish trade, I'm going to try to be real aggressive on those. And right now, again, we're hitting our head against the resistance that we drew. So we drew this line, we might as well use it. Now what I'm going to do is I'm going to start planning already in advance. Okay, so what if it does trade higher? If it breaks and trades higher again, then I'll try that S curve once again. I'm not afraid of losing on a trade, but what I will say is I've already had one $300 loss. My goal now is to take another trade and make more than I just lost, because that's just simple mathematics. If you lose less money than you win, you're going to be profitable. All right, so we have a bearish trigger. We're going to put our stop pretty much right above here, 547. We'll do the math. It's 43 cents of risk. Okay, so what I'll do now is just kind of come up here. I'll just do this. Okay, so 300 divided by 43. That's the difference between the bearish entry and the stop. And that's 697 shares. So notice we keep changing our share price, but our risk is the exact same, still 300. All right, so we have our bearish set up. I think we can get these off the chart now because you all are familiar with it. Now you know how to process your risk. I think that's great. Good takeaway. Are we in bearish, ladies and gentlemen? Yes or no? We are. So I didn't put this in the chat on the chain. I'm sorry. This would have been a stop limit price. Stop limit sell order is how you would put that into your broker. So to get triggered into a trade that hasn't occurred yet, right, you do stop limits. Now that's to get into a trade, not to get out. So this would be, since we're in bearish, this would be a stop market sell order. That's how you would put it into your broker. So you click on stop, you click market, and you'd sell at 547. So we're in this trade. Our risk is 43 cents. And so my goal and objective is to make more than we lost on the previous trade. So I'm going to take the target and kind of put it down here somewhere. And realistically, I'm just basing that off of the support resistance. So I'll show you in a second. So this target, this would be a buy limit order, right? So we're in bearish. The way you exit a bearish position is you buy. So I'm basing this realistically off of this little price right here. Boom, 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 because that's the most recent place that we bounced. And not only that, but if we hit it, which I'm not saying we will, but if we do, then I will have made more than we lost on this trade over here. Now, I haven't been asked this question yet, but I will go ahead and ask it so that you might be thinking it. Could you, ladies and gentlemen, when I mentioned the retest, remember this is a daily chart. Could you have zoomed in to here and played this on the hourly and gotten in on the retest on the top of that S curve? Could you have gotten in on the hourly over here somewhere and had your stop up here and already be up more on the trade? And the answer is absolutely. Sure could. And that's what I try to do a lot when I'm swing trading, is I do my analysis on the daily and then I zoom into an hourly or a smaller time frame, like a 2 hour or 1 hour chart, and I fractalization. Based on the fractals, I try to find a little bit of a tighter entry based on the sentiment of the chart and the sentiment of the candles. Now in this particular function, right, the historical replay on TradingView, you can't switch time frames. So you either have to have multiple charts up or multiple replay sessions, which you can do, but just a little bit of a takeaway. right? Because when you're practicing this, you want to have an idea of what the sentiment is. And once you know that, then you're understanding the candles and you're going to be in much better shape. So from here, we're just going to go forward a day or two and see what happens. We'll analyze each candle. So this is what I refer to as an inside day candle, right? This candle is fully within the range of the previous day. So this is what I would refer to as a rest. This is a resting candle. It doesn't mean the trade will work or won't work, but it's a resting candle. I'm going to leave my stop here for a little bit. And if it breaks down, that will be great. So if it breaks down, that would show me that the trade will continue. All right, so we have another resting candle. We have another resting candle, 3 resting candles in a row. So this should break down pretty soon. If it breaks down bearish, all should be good, right? That's obviously a very nice rest. If it doesn't break down bearish, which very well could happen in a few more days, right? Because remember, these are daily charts. Then I'm going to start lowering the stop and looking to get out of this trade for a small loss or maybe a small gain if it doesn't break down soon, because it realistically should. We can change and look at moving averages and stuff as well. Right, so we can change templates while we're backtracking. So here's the moving averages. So my stop is above all of the moving averages, and the long-term moving averages, right, we are below the 100. And look how crazy this is. Target is actually right there at the 200 simple. So without using the moving averages, everything looks good. I really don't use moving average when I back trade, but right now it should break down. So we're going to keep giving it some time. Give it some time, keep giving it some time, and we're stopped out again. Nice. So here is where a lot of traders will get super frustrated. 2 losses in a row. What do we do? Because we knew if it didn't break down, it didn't do anything, what we have to do now is we have to go back and we have to question the overall trend. We have to start trying to figure out and determine, all right, it's gapping up, it's gapping down. We start zooming out a little bit, because just because you're losing on a trade and you're losing on a stock doesn't mean that you're a bad trader. It could also just simply be that the trade right now that you're trading, the play that you're trying to take overall on the setup, could be an entirely different strategy and a different time frame that you have to use. Because as we mentioned earlier, it is kind of sideways and kind of choppy. It's obviously gapping a lot. It's doing 2 or 3 different moves. It broke out. We took 2 trades, didn't work. So we lost $300 on this trade as well. Now, we can still have our takeaways. We can still learn from this trade. But what I'm going to do is I'm going to look at this as a very sideways move. And at this point, I'm going to start changing my approach a little bit. Because if I got in bullish and it didn't work, and I got in bearish and that didn't work, that tells me that this is going to be very sideways and very choppy. You have to learn, ladies and gentlemen, from the markets. The market's going to do whatever the market's going to do. And if you're trying to trade something that is obviously chopping you to bits, then why keep doing what it is that you're doing? You have to find a different strategy. You have to find a different approach. Or at least that's what I think. Now, we can certainly analyze this gap. I will analyze and talk about this gap, and then I'm going to flip to a strategy that I think is going to be best on this particular trade. And we'll talk about that in just a few quick seconds, where that will draw and go. All right. So this particular gap, right, you have a bunch of bearish traders, and these bearish traders are trapped, right? Because we're trapped. We were losing on the trade. And so these bearish traders, when this gapped up, this is what I refer to as a gap and go. So this is a gap and go, and I love day trading these. These are very fun to day trade, because you know that the bearish traders are trapped. And how do bearish traders get out of their position? They buy to cover. If you have a bunch of buyers, we might as well buy with them. Ahmed says it gaps a lot because it's an American depository. Exactly. Yep. ADR. So this is an ADR. ADR. So this means it's going to gap very frequently. And what I love what Ahmed said is he's looking at the chart and he's getting an idea and getting a takeaway of, okay, this stock obviously gaps a lot. It moves quite frequently and it's kind of choppy. It's a little sideways. And when you get a choppy sideways stock, you have to trade it either with a neutral approach or you have to be in and out faster. Okay, so oftentimes this would be a day trading type of environment. So if it's choppy and it gaps every single day and it's up and down, up and down, up and down, up and down, so day trade it. Don't hold it overnight. So you're either doing a neutral strategy, right? Or you're in and out and you're doing something a lot faster. So what does a neutral strategy look like? Well, there's lots of strategies out there. A neutral strategy would be like a put sale. So I don't know if you're all familiar with buying puts or not, but a put sale is a pretty neutral strategy. So it's bullish, but it's neutral. And what I would do on this particular trade is I would sell a $4 put. There would not be that much money in it. $4 put sale, and I'd have to sell it for probably December 2016, and I'd probably get maybe 10 cents on that per 100 shares, which is one contract. And so now what I'm going to do is, if I'm going to sell a put, the way a put sale works is literally I sell this put down here as long as VALE stays above $4 between now and the third Friday in December 2016, which is this day right here, this pink line. As long as it's above $4 by that time frame, then I'm going to win on this particular trade. And if it's not above 4 and it comes all the way down here and closes at 4, then I'm going to buy some shares of VLE. And then I'm going to play it neutral by starting to turn around and start to sell covered calls and try to get called away and do it more of a longer term approach, a little bit more of a neutral strategy. Because again, if there's not an obvious trend, there's no reason to play it directionally. So let's say, for example, I wanted to do 10 contracts, which would mean I'm trying to control 1,000 shares, which is only a $4,000 investment. It's really not that much. But if you're doing that, 10 contracts, which is 1,000 shares, would be a $4,000 investment, you would receive on that trade $100 minus commission. So let's say you're doing a $1 contract, so your commission, I don't know, let's just say on the high side was $15. So we're going to make $85 on this trade as long as VALE stays above 4. That's pretty much it. So keep in mind, it is good to have neutral strategies that you can use if you are pulling up a chart. Obviously, there's tons of trades and tons of charts that you can take, but it is quite important to recognize if a stock is trending or if it's not trending. So at this point, I'm just going to press play. There we go. So we've pressed play. And ladies and gentlemen, is the stock above $4? And the answer is yes. Yes, it is. It's above $4. So that particular put sale would have worked. Now, could we have taken this breakout right here as it broke out, S-curved? Sure, we certainly could have. But again, if you're doing a put sale, all you're worried about is the stock. Well, I say worried about. Technically, your only risk is if the stock closes below that particular strike price. If the stock closes below that strike price, then you'll get put some shares. And if you are okay with getting put shares, it's really not that big of a deal. So if it works once, then we can turn around and do probably a $5 put sale again on this particular stock. So that one worked. So we do a $5 one. We probably would get 10 cents again, but we'd have to go pretty far out. So we'd have to go most likely to April to get that kind of money. So that'll be April 2017 now. And here's what's exciting is right now, if the stock does trade all the way back down and closes below $5, we probably actually want to buy it down here anyway, because it would be a good place to buy low, sell high. So if we do 10 contracts on this one, all right, here's 10 contracts. Same, pretty much exact same thing. We get 10 cents, so we'd make $85 after commissions on the trade. And we'll just press the play button and see if that would have worked. I'll take the pink line and move it forward to April. Okay, here's April 21st. That's the third Friday. And now we'll just press the play button and see what VALE did. Okay, there's the expiration. All that time, you didn't have to do anything. You didn't have to worry about that it gapped all the time. You didn't have to take a breakout. You didn't have to do anything. You made money with doing that put sale on VALE down at $5, and we could do that exact same trade again. Same exact trade. So this time would probably have to be for August 2017 to get that kind of money on a cheap stock like this. So here's August. All right, still at $5, and I'll just move this pink line to August. And then once this one works, which it most likely will, we will wrap it up. So if I press play again, and I'm looking at, again, it's coming down. If it, sorry, I have the black line at 517, should be at 5. Okay, because I'm selling the $5 put. Not that it really matters. All right, and so again, all VALE has to do is just stay above $5 by August, and there it did it again. So the big takeaway is when you are trading and you're trading a particular stock and a particular company in a particular time frame, you do want to find a really good trend. You do want to find something where it's unquestionable what it's doing. And if it is chopping you to bits and it is getting you where you take a trade and you find it a difficult time to lose, you find it difficult to win, simply adjust what it is that you're doing. Because on VALE, if I try to take two directional trades and lose on them, I can just flip my perspective and go, okay, looks like it's not very directional right now, and just start doing a non-directional strategy, a non-directional approach. And those put sales at this particular point, you're already getting back you're starting to get back into the black just doing these particular put sale contracts. So yes, it's certainly great to know and to have other particular strategies because there are different types of markets. So what I want to do now is go to VALE present day. So if I click on the weekly, we're going to go to present day and we can kind of see what it ended up doing. So here's VALE right now, present day. And what we can see and what our takeaway is, it is at least now starting to make some higher highs and higher lows, but it is still super choppy. Right? It's still, for the most part, trading pretty sideways. So at this level on VALE, you're going to either A, wait for a breakout. Once the breakout comes, you're going to buy that retest. Or you could, I personally wouldn't short it, but you could short it, play it back down into the support. And once it trades back down to this support, then you buy it. Or you can just continue doing the put sale strategy and the put sale approach on this one. In fact, we'll just go look at VALE right now and see what a $10 put sale for January would pay. There we go. So if I take this out, so very similar to the strategy that we were just using on VALE. If I look at this and go, all right, wonderful, a $10 put sale for January 2019, we could get about 8 cents, right, per share. So we did 10 contracts. That would give us the opportunity to buy if VALE does trade all the way down here. Gives you the opportunity to buy it at 10. Or if you want to buy it a little bit higher, maybe you want to buy it at 11. If you did an $11 put sale for January of this year, 2019, an $11 put sale would bring you in 14 cents per contract, which is almost double. And so now you're saying, okay, cool. Well, if VALE does trade all the way down, then I will be okay to buy it at 11. If it closes below $11 on the third Friday of January, and if it doesn't, then I'll make my 14 cents per share, however many contracts you do. Because just like Mr. Kumar said, it's very sideways, and this is on a weekly chart. So it is very important, in my opinion, to overall determine the trend. And when you start practicing, and when you start getting an idea and being able to get a general grasp on a particular stock, and most importantly on the sentiment of the candles, and you're able to read the sentiment of the candles, you're much better able to decipher and determine what people are thinking. this particular approach in the markets where you're doing your back testing, where you're doing historical replay, where you're putting in hours, this is how you can get years of experience in a relatively short period of time. By putting in an hour or two every single night, you can absolutely and massively, amplify your trading prowess. So that was a solid 55 minutes. I know it was a lot of details. For those who are watching the recording, thank you. And for those who are here, if you have any questions at all, let me know. Happy to help any way I can. So if you have any questions, let me know. I do have a product at Real Life Trading that I donate to charity for anyone who purchases. It's me doing exactly what we did today for 7 hours straight. 7 hours straight without stopping. Seriously. So I did it. So you know how people do like marathons for trading or for charity? I did this. I called it a back trading marathon. I did it for charity. It's me doing exactly what we did right now, talking nonstop, trading nonstop on the charts for 7 hours. If you're crazy enough to do it, feel free to. I posted the link. Again, proceeds go to charity because, why not? All the other education and information, if you want to learn tons of information on real life trading, it is entirely free. And my mission of the company is to enrich lives. So I appreciate you being here. It's been an honor and a privilege. Mr. Kumar says, thanks for today's very useful session. Oh, my absolute pleasure. Hope you had a lot of takeaways. Hope you learned some things. Hope this will help you in your trading career. And if you do ever have any questions for anyone who's watching this, you are welcome to email me, Jeremy@reallifetrading.com. I love working with the Top Shelf team and continue to be a part, continue to enrich, continue to learn and progress. Ahmed says, thanks, Jeremy. Ahmed, my pleasure. Thank you for being here. Jason, I'm done. My friends from around the world, you guys rock. Bye.
That was awesome. Thank you very much, Jeremy. Everyone will be publishing a recording of this along with ways to contact Jeremy if you want follow-up information. And we are right at the top of the hour, so couldn't have been any better. Exactly what we were hoping for. Have a great day, everyone, and look forward to our next event.